Hi, I'm Alex Grainer, and today it is the last day of July 2022. We'll talk about momentum investing, probably the most effective among investment strategies, which is based on market trends. We'll also compare this approach to value investing. The presentation that follows is a shortened version of the lecture I recorded for a Chinese investment conference earlier this year. I hope you'll find it interesting and illuminating, particularly for those among you who trade and manage their own investment portfolios. In today's uncertain times, I would encourage investors to consider diversifying their assets and to look into systematic trend following to navigate the roller coasters that lie ahead, and to consider subscribing to our daily Trend Compass newsletter, which provides trading signals based on the iSystem, our trend following model that has proven superbly effective and reliable for over 20 years. 1 month's test drive is always free of charge, and you'll find the link to Trend Compass page in the description below this video. Now, without further ado, let's dive into momentum investing. In today's presentation, we'll cover a few subjects related to investment trading. First, we'll briefly cover the monetary system, inflation, and the reasons why we need to generate investment returns. We'll address uncertainty as the key problem facing all investors and traders, and also the helpful fact the markets move in trends. We'll take a closer look at trend following and momentum investing and compare the momentum strategies with value investing. We'll conclude with a few do's and don'ts that all investors should observe in managing their portfolios. The fundamental reason why we need to speculate and generate positive return on our investments is rooted in the nature of today's monetary system. Everyone understands that we can't keep our savings under the mattress for a long time because their value steadily declines over time. This is due to inflation, which slowly reduces money's purchasing power. Inflation is a relatively modern phenomenon. In this chart produced by Deutsche Bank's researcher Jim Reed, we can see that through history from 1200s on, inflation hasn't always been a problem. This abruptly changed in the 19th and the 20th centuries, with the emergence of fiat money and fractional reserve banking. The chart on the right shows the effect of this new normal. Under the fiat monetary system, money creation has been disconnected from the stock of gold, silver, or other commodities. This enabled the banks to vastly expand the supply of currency. The result is that the purchasing power of currency steadily diminishes over time. Today, all economies in the world have adopted this monetary system. As a consequence, everyone's money is gradually losing value. Over time, this leads to a dramatic debasement of the currency, as we can see in this chart showing the decline of US dollars purchasing power from 1910. This dynamic has made it necessary for people to invest their savings and to generate positive returns on these investments. But in addition to preserving our wealth, we are rightly inclined to use our capital for profitable enterprise even in absence of inflation. Almost 800 years ago, St. Thomas Aquinas wrote that if the highest aim of a captain were to preserve his ship, he would keep it in port forever. Of course, people do not build ships in order to preserve them, but to put them to work in profitable enterprise. The same is true for every other form of capital, including your savings. Our success in investing will depend on the quality of decisions we take and execute over time. We can only make decisions in the present, but the result of those decisions will depend on future outcomes. But the future is shrouded in uncertainty. We have no way of knowing what might happen tomorrow, next year, or 10 years from today. This uncertainty is the most difficult problem facing all traders, investors, and hedgers. Today, the financial industry and trading companies employ an army of analysts that try to overcome uncertainty with the help of economics, forecasting, and various quantitative methods. But forecasting based on economic modeling has proven quite useless in predicting the future, and quantitative methods based on mathematical models are often unreliable and rife with risks. There is, however, one feature that we encounter in nearly all financial and commodity markets, which can help us overcome uncertainty, and that is that markets move in trends. In fact, I believe that this is the single most important fact that investors should always keep in mind. Trends are ubiquitous, and the strategy of investing with trends or trend following is one of the most successful investment strategies. Trend following works because large-scale price events represent the single greatest source of opportunity for investors, and because these events almost invariably unfold as trends that can span many months and even years. We see trends in all kinds of markets where people exchange stuff. Already 2,000 years ago, Sun Tzu identified them as one of the three main avenues of opportunity. Let's see a few examples of trends in major financial and commodities markets. Here we have the US technology index Nasdaq. In spite of several large corrections and bear markets, Nasdaq has advanced more than 100-fold over the past 50 years. Here is the price of Tencent through mid-2020. But trends don't only go up, they also go down, enabling trend followers to profit even in bear markets. Over a 3-year period from 2011 to 2013, the price of coffee more than halved in a straight downtrend. Here we have a 6-year downtrend in euro versus the US dollar. Interest rate on US 30-year Treasury bond declined for over 30 years in a very even macro trend. Trends don't only appear in formal security exchanges. In fact, they emerge in almost any organized market, including collectible items, art, wine, and other things. Here we have a 25-year price chart of New York City taxi medallions, again manifesting large trends. First, a 20-year rise, followed by a downtrend that spanned 5 years. We've also seen powerful trends in the new cryptocurrencies. Here is the price of Bitcoin. Chinese investors will recognize the chart of the Shanghai Stock Exchange Composite Index. This one looks a bit different, but it nevertheless manifested a few strong trends, and for an experienced trend follower, it is clear that trading the Shanghai Composite Index could have been exceptionally profitable. Finally, here's the stock price of the electric car manufacturer Tesla. Tesla is one of the most remarkable cases of price trends in the recent years. In July 2010, Tesla's share price was just over $3. In May of last year, it peaked at over $1,200, a rise of 387 times in a little more than 11 years. Tesla's stock share rose so much that in late 2020, Tesla's market cap surpassed that of the next 7 large car manufacturers combined. Let's have a look at the way this shaped up. Over the last 10 years, the S&P 500 index increased by over 300%. But the car manufacturers have not been a great investment. For every dollar invested in Toyota in 2011, at the end of 2020, you'd have about $2. If you were unlucky to invest in Ford, your investment would be worth just over half. With most of the others, you'd get something in between. All in all, none of these car companies were a great investment. But let's see how their share prices compared to Tesla's shares. Here it is. This chart is on a logarithmic scale because on linear scale, the stock shares of the other car manufacturers would almost look like straight lines. The dynamic captured in this chart has great significance for our case here. Namely, while Tesla's valuation would be difficult to justify on any rational basis, the undeniable reality before us is that Tesla massively outperformed its peers, and this change unfolded as a trend that's held for over a decade. It is important to understand that this is not an anomaly, but only a recent and perhaps spectacular example of the recurring theme that markets move in trends. And once trends get going in earnest, they often eclipse all our notions about asset valuations, both on the upside and on the downside. This happens regularly. It is not an exception that should surprise us. Now, if you had the wisdom and the foresight to buy shares of Tesla and hold them for 11 years, you would have done extremely well. But how many of us have such wisdom and foresight? Probably not very many. However, what if you always just picked winners? Suppose you systematically invested in top-performing stocks regardless of what you thought about the companies in questions, about their valuation, their products, or their management teams. If you did that, you'd be onto something very powerful. This is what we call momentum investing. Momentum investing is a variant of trend following. It seeks to systematically pick top performing stocks and hold them for as long as they outperform. How well does this strategy work? It works extraordinarily well. A very extensive empirical study covering over a century of data showed just how well momentum investing performs. London Business School researchers Elroy Dimpson, Paul Marsh and Mike Staunton analyzed the history of stock prices in the London Stock Exchange starting from the year 1900. They constructed investment portfolios by selecting 20 top-performing stocks in the previous 12 months from among the UK's 100 largest publicly trading firms and compared their performance to portfolios of 20 worst performers, recalculating the portfolios once every month. They found that the lowest performing stocks would have turned £1 invested in 1900 into £49 by 2009. By contrast, the top performers would have turned £1 into £2.3 million, a 10.3% difference in compound annual rate of return over a 109-year period. When they included in their study all of the London stocks from 1955 onwards, the gap was even wider. The top 20% generated a compound annual rate of return of 18.3% versus 6.8% for the bottom 20%. The researchers found the strategy to be striking and remarkably persistent. It proved successful in 17 out of the 18 global markets studied, with data going back to 1926 for North America and 1975 for larger European markets. The only exception was Japan, where the results were based only on the post-year 2000 data, the period that coincided with a protracted bear market in Japanese stocks. Thus, Dimpson, Marsh and Staunton studied a massive chunk of stock market history across 18 global stock markets and gave us irrefutable evidence that trends really are the most powerful driver of investment performance over the long term. This principle has held true throughout the two world wars, the 1930s depression, the Korean War, Vietnam War, 1970s inflation, the collapse of the communist bloc, the rise of China, 9/11 terror attacks, and the global war on terror. The century covered by this study has been a massive roller coaster for the global capital markets, and through all of it, markets manifested powerful trends as the most potent drivers of investment performance. Well, what about value investing? The success of trend following and momentum strategies may seem puzzled from the strictly common sense aspect, namely, they involve buying high and selling low, which is contrary to our natural inclination to buy things at a low price and try selling them at higher prices. This inclination makes value investing intuitively appealing. We all like the idea of buying something when it's inexpensive and selling it when it's overvalued. After all, this approach is at the core of value investing that has made Benjamin Graham and his disciple Warren Buffett some of the world's most successful investors of all time. Well, not really. A more careful analysis of Graham's as well as Buffett's writing and investments turns up a big surprise. Both men were in fact largely momentum investors. Graham wrote Security Analysis and The Intelligent Investor, today widely considered as the two most important books on investing ever written. Graham generated an extraordinary annualized return of about 20% over a 20-year period from 1946 to 1966. During this time, the stock market overall returned only about 12% per year. Warren Buffett himself generated a compound annual rate of return of over 18% during a 30-year period. The S&P 500 index returned 10.8% during the same period. While Graham and Buffett are generally regarded as value investors, their success had more to do with market trends than with superior value-finding skills. In The Intelligent Investor, Graham observes powerful market trends as they confounded his value judgment on stocks. In 1953, as the US stock market enjoyed one of the longest-running bull markets until that point, Graham cautioned investors that the stock prices were getting too high. As it turned out, he later wrote, this was not a particularly brilliant counsel. A good prophet would have foreseen that the market level was due to advance an additional 100% in the next 5 years. By 1959, the Dow Jones Industrial Average reached an all-time high at 58.4. And again, Graham warned investors that stock prices were far too high. Regardless, the Dow rose to 73.5 by late 1961, and after a 27% correction in 1962, it soared further to 89.2 in 1964. In sum, Graham thought that the stocks were overpriced in 1953 as they were about to triple in value over the next 11 years. Selling your investments before a 200% bull market isn't a good way to earn great investment returns. So how did Graham generate the remarkable results from his investments? The simple answer is by not following his own investment advice. Instead, Graham inadvertently did what a trend follower or a momentum investor might have advised him to do. He held on to his best performing investment even though it was overpriced from the start. Namely, in 1948, he and his partner Jerome Newman purchased a 50% interest in the Government Employees Insurance Company, or GEICO. The $712,500 purchase was roughly a quarter of their fund's assets at the time. Here's what Graham says about their GEICO investment in the postscript to The Intelligent Investor. It did so well that the price of its shares advanced to 200 times or more than the price paid for the half interest. The advance far outstripped the actual growth in profits, and almost from the start the quotation appeared much too high in terms of partners' own investment standards. Graham explained why he and Newman did not sell GEICO even though they judged its price much too high. Because of the size of their commitment and involvement in the firm, they regarded it as a sort of family business and maintained ownership in it in spite of its spectacular price appreciation. In Graham's words, the profits from this single investment decision far exceeded the sum of all the others realized through 20 years of wide-ranging operations in the partner's specialized fields, involving much investigations, endless ponderings, and countless individual decisions. In other words, far more than one half of Graham and Newman's performance came from the one investment they kept through a 2 decades bull market and did not sell it even though it was grossly overpriced in terms of partners' own investment standards. That implies that all their investigation and endless pondering contributed less than 10% in annual returns, underperforming the stock market by at least 2 percentage points over the 20 years. That further implies that if Graham and Newman had only invested in GEICO and spent the rest of their careers fishing and golfing rather than burdening themselves with investigations and endless ponderings, they would have done at least twice as well as they have done, generating an annual return of over 40% or more from 1948 to 1966. For his part, Warren Buffett's style reveals much more of a momentum player than value picker. He made many of his large investments on the back of major run-ups in stock prices. Examples include his investments in Capital Cities in 1985, Salomon Inc. in 1987 and 1994, Coca-Cola in 1988, Gillette in 1991, Freddie Mac in 1991 and 1992, General Dynamics in 1992, Gannett Company in 1994, and ConocoPhillips in 2007. For example, when Buffett bought over $1 billion of Coca-Cola shares, they had appreciated more than 5-fold over the prior 6 years and more than 500-fold in the previous 60 years. This decision proved right again as his investment in Coca-Cola quadrupled in value over the following 3 years, far outstripping the S&P 500. And like Graham before him, Buffett owes much of his success to GEICO. He started buying its stock in 1975 at $2 per share and kept adding to this investment even as the company's market cap went from $296 million in 1980 to $4.6 billion in 1996. This growth in valuation corresponded to a compound annual rate of return of 29.2%, an outperformance of more than 20% per year over the S&P 500. Did Warren Buffett sell this overvalued company? To the contrary, in 1996 he bought 50% of GEICO, making his firm Berkshire Hathaway, 100% owner of Geico. This was not exactly a value pick, but the decision again proved a winner. By 2011, Geico's market cap nearly quadrupled to $20.5 billion. Even though Graham and Buffett somehow came to epitomize the so-called value-driven investing, they both owed their success entirely to market trends. In the American stock markets, bullish trends were out in full force through most of Graham's as well as Buffett's careers, which were most abundantly blessed by some of their most overvalued investments. In essence, Graham and Buffett may both have overtly espoused value investing because it's a rational style that sits well with investors. However, they both achieved all of their outperformance through momentum investments and not by superior value picks. A great body of evidence leads us to the conclusion again that market trends are the most powerful drivers of investment performance over the long term. Trend following, if done correctly, is the most effective approach to navigating uncertainty facing all traders, investment, and hedgers. But in spite of this evidence, momentum has not been very popular among investment managers. In part, this has to do with the persisting cultural preference for value investing, which includes the belief in mean reversion. Mean reversion basically predicts that things that rise too high will come back down, and values that drop too low should rise back up. That implies that we should sell overvalued assets and buy undervalued ones. But as we already saw, things don't quite work that way in the markets. A report produced by Goldman Sachs analyst Sam Rowe in April this year cast some doubt on the idea of mean reversion. Sam Rowe wrote that, while valuations feature importantly in our toolbox to estimate forward equity returns, we should dispel with an oft-repeated myth that equity valuations are mean reverting. We have not found any statistical evidence of mean reversions. Rowe's analysis suggests that the mean reversion significance of the Shiller-Cape metric since 1881 is very low at just 26%. I believe that a truly successful approach to momentum investing would have to be based on systematic trend-following strategies applied either to large numbers of individual stocks or to sector indices like energy, utilities, industrials, biotech, and so on. The double-digit outperformance of momentum strategies over value would make this an interesting and very worthwhile strategy. I would like to conclude this presentation with a handful of guidelines for investors based on my own experience in trading and investment management. First, study technical analysis. Trend following is not based on the study of economics or stock valuation metrics. Rather, trend following is based on the study of historical price charts. As you spend time analyzing hundreds or thousands of price charts, your judgment will improve and you will be able to better identify trends and spot the good buying and selling opportunities. As you learn to read charts, your investing will also become more versatile. You'll be able to trade in markets even if you don't know everything about them. Over my trading career, I've actively traded in well over 50 different financial and commodity markets, including things like cotton, platinum, natural gas, and frozen orange juice. And I can confess, I know close to nothing about most of them. Use daily price charts. You'll discover that chart patterns and trends regularly appear in intraday charts like 5-minute or 60-minute charts. In fact, they appear in almost any scale, really. But these patterns will show relatively small price moves. Real trends comprise large-scale price events that can span many weeks, months, and even years. This is where the greatest opportunity lies, and the most effective way to identify them is by studying daily price charts. Do not day trade. Best investing opportunities lie in price moves that take a long time to unfold, and day trading is not the way to do it. In fact, day trading is a good way to lose money. Evidence suggests that as many as 95% of active day traders lose money. Target about 10 to 15% returns. We would all like to double our investments every year, but this is not realistic. In the long term, stock markets have tended to compound at about 10%. The best professional investors tend to achieve about 15% annual returns. This doesn't exclude the possibility of having a much more successful year, and even some bad years, but over the long run, your target should be about 15%. Choosing a realistic target will also help you determine how much risk you should be taking on investments. Do not chase after losses. Your success as investors will depend on the cumulative quality of all trading decisions you take and execute over time. Occasionally, you'll make some really bad decisions that will cause you uncomfortable losses. But this is a normal part of the investment process, and you should be prepared to accept it as such. Many investors attempt to recover losses by price averaging, buying more of the losing stock in order to lower their average purchasing price. This is not always a good idea. The advice that you should cut your losses and let your profits run is literally true, and it is also consistent with trend following psychology. Chasing after losses can easily result in bigger losses. Finally, always cultivate steadfast discipline. Invest for the long run and avoid gambling. If you enjoy active trading, consider setting up a separate account with money that you can afford to lose. Managing the principal part of your assets should not be an entertainment, and it should be done with strict disciplined adherence to a well-formulated long-term strategy. In the end, I would like to add another important reason to consider trend following as a way to navigate the unpredictable market swings. Market trends reverse and asset bubbles ultimately always burst. Trend following can help you identify when bull markets reverse into bear markets and even profit when stock prices go down. In fact, as these charts illustrate, bear markets can also last many long years, and in those environments, trend followers tend to perform well. For example, during the last bear market in 2008, I have been able to generate a positive performance of 27% for my investors. I was able to achieve this because I used systematic trend following to navigate the price changing. Trend following can help you determine when to get out of the market and go short, and also when to get back in on the long side. Trend following can turn your investing into a lifelong success story. Thank you very much for following my presentation. I hope you found it interesting and instructive. I also wanted to thank the very helpful and professional Bogu Forum team for their kind invitation and for their work in organizing this presentation. I wish you great success with all your investments, with good health, prosperity, and peace. Thank you.